Welcome back to the special edition of Indianomics, where we are discussing the March inflation data and the state of the economy. The March inflation number, headline number, came in at 3.34% versus the CNBC-TV18 poll of 3.59. This makes the Jan-Feb-March average CPI down to 3.7%, whereas the Reserve Bank's forecast as recently as February was as high as 4.4%. So that's a measure of the disappointment or the fall in inflation, which is above the Reserve Bank's expectation. The IIP data, industrial output data for February, was also a disappointment, coming in at 2.9%, as bad as perhaps the Jan data. So, as bad as the December data. So we are seeing a lot of poor readings in growth and lower readings in inflation. The lower 3.34% inflation number for March comes on the back of a 2.69% food inflation data and a 4% core inflation, but core subtracting gold would still fall to 3.2%. So basically, an all told lower than 4% inflation number is what we have. I've been speaking with Aditi Nayar of ICRA, Devang, Shah of Axis Mutual Fund, Narang of ICICI, and Radhika of DBS Bank. Ladies and gentlemen, thank you for your patience. Let me get your growth forecast now. Radhika, where do you stand in terms of Q1, that is April, May, June, as well as full year FY26?
Sure. For the current quarter, the quarter we are in, we are at about 6%. And for the year, we're going to take it down to about 6.3. Still a lot of, like Samir mentioned, now that the tariff, the risk of a high headline tariff has gone away, even then, I think there is quite a bit of blowback expected from slower global growth. If you see the conversation, the narrative is kind of changing now. We're not talking about the impact from tariffs as much as talking about slower growth in the US, slower growth in China, thanks to the, trade dispute between them, which is going to impact this part of the world as well. And not only does weak global growth really only impact exports. It also tends to have impact on the capex interests as well. In fact, one of the work that we had done tried to map what was it that private sector players were looking at. Were they looking at lower interest rates, and were they looking at more interest coverage ratios, or were they looking more at demand? And that clearly showed that demand is something locally and globally that really impacts their capex commitments. So I think that's something to watch out for as well. To come back to your question, yeah, we are a full year at about 6.3%, lower than the central bank's projection.
Yes, certainly, but not as low as some numbers that I have got on the street. For instance, the Goldman Sachs number is 6.1%. So there are people who are cutting growth forecasts primarily because of the global overhang. Samir, what's your current number, and is there a downward bias?
So we'd cut the growth forecast to 6.2%, Latha, after the reciprocal tariffs were announced. Even in our NPC review, we mentioned that. Though the tariffs have come down, but I think the indirect effects, the uncertainty, the equity market inflows, all of that get impacted. So all of that put together in some summary, 6.2% is our growth forecast for the year. And more or less each quarter is around that number, 6.1 to 6.3. And a lot will depend on how spending pans out, because exports are likely to be weaker. So if oil prices do come down and government increases excise duty, that will give it buffer in order to spend. And we should remember in 2015 to 19, and that is how we managed the 6.7% growth with the oil prices at $45 a barrel. That was a big kicker for domestic spending led by the government.
No, I agree. But, a lower oil price has also coincided with lower remittances. And, with the uncertainty over global growth, probable recession. I mean, there are some people who give a 50% chance of a recession in the US. Even services exports could come under a bit of a cloud. At least the TCS management warning or guidance was not very encouraging. Where does ICRA stand, Aditi, in terms of growth forecasts?
So, Latha, we also reduced our growth forecast from 6.5% to 6.2%. And as of now, very similar to what Radhika and Samir said, uncertainty, disruption, supply chain issues, sentiment issues, and I think certainly private capex is going to get deferred in sectors that either have a large component of exports or where imports can come in very easily. So I think 6.2% is a fair number to work with for now for the full year. Now, I'm not actually going to give you a Q1 number. I think it's far too early. We don't know whether exports are going to get front loaded into April, and we also don't know how the government capex program and other things are going to kick off. I think it's not very prudent to really plug in a Q1 number right now. But for the full year, we have knocked off our forecast by 30 basis points.
Okay. So basically, we are averaging between 6.1 and 6.3. I think that's the best number I got over here. So we have to run with a 6.2% average from this panel of economists. I've heard lower numbers, of course. Devang, what is the, final repo number that the market is working with? Is it giving you a sense of 5.25 in this cycle?
So my understanding is that at this point of time, large part of the market is pricing in between 5.25 and 5.5. So it's somewhere in between there. Our expectation is also that probably, yes, 50 basis of rate cut is very much possible from current levels, whether it is one policy, 1+1. It depends on how the impact on growth is, and that is where it's going to determine the policy actions. The important point for bond markets is that I think two things which I touched upon. One is this liquidity entire piece, which is very, very positive. The second thing is the amount of OMOs which RBI has done, and he is front loading it because of FX outflows and currency leakage, which happens in this quarter. So the net supply for the month on government bonds for April is almost zero, because we have seen 1,20,000 crores of OMO announcements. So I think that is also being a big catalyst for bond markets and the rally behind on the yields front. The only caution or word of caution I think probably all of us are looking at is what's happening on US Treasury yields. And if you ask me, I think because there's a lot of dollar weakness and this entire rise in yields is keeping bond markets, probably the rally is getting a bit slower. Otherwise, for the dovishness which RBI governor spoke about in the monetary policy, for the liquidity actions, I think yields could have rallied further.
No, I take your point, but there could be a divorcing of inflation trends in the Western Hemisphere and in Asia. There is, of course, an expectation that in Asia, because China could be locked out of exports to the US, that those goods and services, those goods could look for a home in other countries in Asia. So a disinflationary impact on other Asian economies cannot be ruled out. So we should be prepared for this, and therefore divorcing of interest rate cycles as well. In any case, the expectation is at least a couple of rate cuts. At least that's what the Fed Fund futures are telling us. A couple of more rate cuts in the US as well is expected. So the expectation that the Reserve Bank will hold back because of what it expects from the US perhaps has to be changed at this point in time. We're already seeing a weaker dollar. So that one threat to the Indian currency also seems less. The conclusion on whether the rate cut will come, of course, it's a long time from now to June, and we could have many Trump tweets in between to know, how the interest rates might move. We are out of time, but thank you very much, Radhika, Aditi, Devang, and Samir. The consensus from our economists is that the Reserve Bank will go with only a single rate cut of 25 basis points in June, and the end rate cut will be 5.5. That is 4 rate cuts in this cycle. But as Devang of Axis Mutual Fund points out, the market is pricing in a possible double cut of 50 bips in June because of the far lower than expected inflation number we have got for March and disinflationary expectations in the rest of the year as well. The other compelling reason for the Reserve Bank could be that growth is also likely to disappoint on the downside, and therefore asking for advancing the rate cut. If it is anyway going to be given in August, why not in June itself? That's my conclusion, but not the conclusion of my economists who still expect a single rate cut in June. But the important takeaway today is inflation is far lower than expected, including core inflation, which is actually 3.2% if you count it ex of gold. That's it on this edition of Indianomics. Thanks much for watching. There's more news and headlines lined up for you after the break.